Hello, my name is Kathryn Rooney Vera, Chief Market Strategist at StoneX. It's a pleasure to be addressing you today. The markets have certainly rallied off of the April lows. Here in the United States, the S&P 500 is up more than 30% from the beginning of April when we had the trade war scare and Liberation Day. But here's the simple truth. What has driven us to record high after record high? It's liquidity and positioning rather than fundamentals. That's supportive near term, but it also leaves us open to a vulnerable place if liquidity dries up. This is why dips have been bought. It's because of chasing the market. So people were not in the market when it rallied tremendously, and they continue to buy the dips. Equity exposure this year started very, very high with regard to asset managers, active managers. And then it was taken down to a very low percentile by April. So since April, what has been the case has been this: when prices rebound, underweights were chased. The chase happened because of not better earnings or stronger growth. That chase did the work. So near term, that still helps market sentiment from now through year end, December of this year, in terms of risk assets globally. But once positioning normalizes and real money or discretionary investors are more heavily weighted in equities, that tailwind chasing the market tends to fade. So liquidity we've seen is very, very high. Money markets are at all-time record highs. These funds are the largest buyers of US T-bills, Treasury bills, and a key part of the short-term financing here in the United States. And as probably many know, we have a massive fiscal deficit here in the United States, and a lot of that is financed with short-term debt, so T-bills. When the Federal Reserve cuts rates, which is happening and is likely going to happen this month in October and again in December, the yield on what cash is earning in these money market funds falls, and money leaves money market funds and finds another home. Flows can move very quickly. They can move overnight. So issuance plans adjust by the quarter here in the US. So that timing mismatch can cause short-term funding discrepancies or problems. And that's when you get a little bit of a crunch like we saw at the end of 2018. So liquidity is supporting the markets for now, but vulnerabilities could arise as the Fed cuts rates and we get some tightening of financial conditions. So that's what we're seeing as the main impulse of the market rally this year. And now that liquidity regime and the development of that liquidity regime is what will continue to drive market appreciation or lack thereof over the course of the next probably 12 to 24 months. So let's start with the stagflation story. We hear a lot of talk about recession or stagflation. We're not there yet. Stagflation means high inflation with weak growth and high unemployment. That's not the current mix. It could it potentially be the future mix, but it's not. And it doesn't look like it's happening, at least for now. Growth is positive and strongly so. Inflation has cooled towards the low 3% area on core measures, sticky with potential to move higher. Unemployment remains low, slightly rising, but nothing too scary at the moment. The economy can handle measured rate cuts without losing credibility. That is, unless and until we get a more meaningful rollover in the labor market or a stronger economic slowdown. We're just not there yet. Right now, financial conditions here in the United States are actually easy looking at history. The broad indexes that track credit, spreads, equity markets, and funding still sit in easy territory. So that shows this idea of very abundant liquidity. Meanwhile, policy sits in a narrow lane. Real policy rates remain high. That argues for cuts. Inflation expectations are anchored but sticky above that 2% target, between 2.5% to 2.6%. That caps how far the Fed can go in terms of cuts without risking credibility. So cuts are going to continue, but we think that the back end of the curve can stay elevated even as the front end declines because of all of these dynamics that I'm referring to. The fiscal structure and the fiscal situation is very relevant here. Here in the US, the deficit, it remains extremely large, and interest expense, the share of gross domestic product, has jumped quite a bit in recent years. So interest cost now, what the US is paying on our debt, now exceeds what the US spends on defense, which is very, very large in and of itself. The public debt path then is trending towards triple digit percentages of GDP over the next decade. More duration, therefore, has to be absorbed over time. That makes the term premia, the back end of the treasury curve, move higher. And probably higher than many think. So the steepener in terms of rates trades will continue to work in our view. Who finances the debt matters. Official foreign ownership, while still strong, has declined as a share of total ownership of US Treasuries. The Federal Reserve owns a smaller share than in the past. We're still in quantitative easing mode. So they're rolling off the assets off of the balance sheet. That leaves more supply for price-sensitive private investors. So private investors care about the price. Central banks care far less. They're inelastic to price. So when you see more private balance sheet accumulating those treasuries, that coincides with higher yields. So this is the slow structural force under the market as the Fed rolls off assets off of its balance sheets, unwinding QE, as central banks in Russia and China, Saudi Arabia diversify out of treasuries into gold and other assets. This causes the back end to move higher in terms of yields. Fair value models that we estimate at StoneX for the 10-year tell the same story. So the 10-year is fairly valued right now, but deficits and term premia are going to keep the term premia pretty high. Growth can soften without a proportional fall in long yields. So where do we stand now? Trade and supply chains add a structural price floor. So deglobalization is inflationary. Globalization is deflationary. So the world has shifted from a globalization framework towards deglobalization. Durable goods prices, which fell for decades, are bent higher, probably going to move higher. Production is being rewired for resilience, national interests, and geopolitics. So this will keep inflation, in my view, stickier than in the pre-pandemic era. Now for the dollar. Maybe you all have heard about the dollar smile framework. I think it still holds. The dollar tends to rise in global stress or US outperformance and soften in broad expansions. So the pattern that had the dollar and the United States yields moving together, that broke in 2023. The near-term baseline points to gradual depreciation into next year with safe haven strength in shocks. So were there to be a shock, the US is, of course, the safe haven currency. That shapes how we use inflation-protected bonds, gold, and selective currencies in portfolios. So let's think about this in the case of Brazil. Brazil sits at the crossroads of global liquidity and local policy. When I say liquidity, I mean the willingness and the ability of an investor to take risk. And you can see that visible in cash balances, credit spreads, and primary issuance. In Brazil, you can see that willingness shows up first in local rates and in the currency. As global cash moves from high cash yields to lower cash yields, funding can tighten for a period. That transition matters because it touches the currency, the local curve, and external flows at the same time. What I can tell you is that Brazil at this juncture looks attractive in terms of yields, especially when we're talking about a US that is overextended in valuations and a Fed that's going to be cutting rates. With that juicy carry in Brazil, we do see international investors increasingly looking at valuations and opportunities there. Brazil's central bank ran a very disciplined stance that delivered disinflation. Real policy rates, those still remain high by global standards, making that yield look attractive, and that creates a cushion for the local curve. Fiscal credibility is the swing factor. The fiscal framework sets the rules and markets price the path. So term premium Brazil, which is the extra yield over expected inflation, moves with confidence in that path. So in terms of the currency lens for Brazil, the dollar tends to rise in stress and soften in synchronized growth. So for Brazil, the currency responds to three forces at once: terms of trade, and that's improving, especially from the trade war. Brazil is one of the few countries that actually benefits from the trade war, from iron ore, oil, and the farm complex, commodities complex, and global risk appetite. So when there's more risk appetite, more search for yield, then the more liquid markets, the larger markets tend to do better. And that would be, for example, Brazil or Mexico. And then you have the domestic fiscal narrative. So when those three things align, the carry works. Of course, there's the political aspect that comes with Brazil, but I can tell you as an international market participant advising international investors that there is some anticipation of a change in management in the Brazilian government, and that would augur in, if it's a more market-friendly administration, additional upside for Brazilian assets. So when these factors are considered, the currency can move quickly. Position sizing and hedging matter more than ever. Public fixed income and equities are both areas that we're looking at with regard to Brazilian assets. Now, back to the US with regard to AI, because I get a lot of questions with regard to artificial intelligence and tech, and has it seen its biggest jump in valuations and in price surge. I think the answer is that artificial intelligence remains the main investment vehicle right now in the country. Everybody wants in on this. This is in a corporate investment cycle that's in full-on boom. So this is a cost. Companies are investing in AI. They haven't quite used AI yet to produce productivity and earnings. So the spending is front-loaded. We're talking about investment in data centers, servers, energy, and monetization of AI spending has not been there quite yet. So what we're seeing is a risk there. A hard bottleneck is coming in the pipeline. We have grids that are getting maxed out. The bottleneck is in energy. In the US, we have large data centers clustered in certain grids. And the utilities plan has to keep pace with this amount of hard use. Connection queues are going higher, and this is a physical. This could break some of the scalability of AI in the future. So this is something that we're looking at. Brazil has a structural advantage in energy, so the power mix includes hydro, wind, solar. The main constraint is transmission and connection, not generation. So this creates, in our view, a clear opportunity set: transmission concessions that add capacity, distribution upgrades that cut non-technical losses, long-dated supply contracts for renewable power tied to data center growth. The winners are operators that turn capital spending into measurable efficiency and cash flow. So this is how we see liquidity meeting the real economy. When capital is abundant, you get a lot of investment, you get a lot of liquidity, you get a lot of capex. When capital costs rise, or you get some bottlenecks or constraints, the market demands proof of returns on their investment. So in the next phase of the AI and of the market cycle, we're looking for the edge to shift to companies that already are showing efficiency gains from the use of artificial intelligence in margins, in economies of scale, and in revenues. So we're not looking for this steep catch up with others with regard to the massive investment and spending in infrastructure. So we need to see some payback from these investments. And we think that the technology space is going to benefit those that have used it for productivity gains. So bringing markets back into the frame, Valuations in the United States are extended. We have the S&P 500 at 21, 22 times forward earnings. That's a stretch. It's not insane, but it's pretty steep valuations. So what does that mean? That means when earnings continue to come out very good, like they're coming out very well, then you can get valuations continue to move higher. However, when you get earnings that disappoint, which we can't discard, then you could get some serious volatility in the markets and potential for market corrections. So be cautious here going into 2026. When we look at other aspects of the global macroeconomic framework, we consider commodities. And that, of course, is really important to Brazil. So when we consider the oil outlook, that points to oversupply going into next year as OPEC Plus normalizes output. We think gold has support pillars that include inflation, geopolitics, dollar risk, and central bank demand. We still like gold. We've liked it for 2 years. It's done very well. It's even outperformed equities. Positioning already reflects a lot of that. So a fresh rally, a big explosive rally, would need some impetus. So as of this moment, we're not expecting another huge leg up in gold, although the sponsorship there remains. Copper has been resilient, should find some support from rate cuts and supply issues. For Brazil, that mix supports of selective energy, metals, and logistics. As I mentioned, where free cash flow leads capital allocation. In general, emerging market flows matter in this environment. What we've seen is flows into emerging markets starting to pick up. Equities have turned higher. And this is because global cash is looking for income and it's looking for diversification, especially as we see a very somewhat stable macroeconomic framework. What the Liberation Day and the Trump trade war really hasn't caused this recession or collapse or freezing of global supply chains as many had anticipated. And in fact, we've seen somewhat of the opposite effect. So Brazil screens well in our view with regard to the tailwinds that we see, the policy progress, the likelihood of some adjustment in the politics, and the attractive real yield. So income is back, and it's not just limited to the United States. This is something I've been talking about in the media and in my road trips throughout the world, talking to different investors, is that we don't just have to look at in the United States. We can look elsewhere for value and areas that still have to play catch up to the United States, which has done exceedingly well. So just to give a kind of tie the threads together here, the economy is not in stagflation. It's not in recession. Policy can ease at the margin. It's going to, it is. Fiscal dynamics, deglobalization, and power constraints are going to keep the cost of capital and production higher than in the last cycle. Liquidity is ample now. That's why dips keep getting bought. But liquidity can move the opposite direction very quickly. And so that's why we think it may pay to wait. What are we watching to validate or change this view? We're looking at money market balances. We're looking at treasury bill demand, refunding announcements for signs that supply composition is shifting faster than demand. Watch inflation break-evens for a drift above 2.6% that would limit the Fed's room to cut. The Fed is very cautious and watchful of inflation expectations. We're looking at the ability of earnings revisions and where earnings revisions are going, and earnings to continue to keep pace as we've seen. So because spending is front-loaded in AI and power is the bottleneck, our view is shifting more to tech companies and assets that already generate cash. The investment recommendations for the global scenario is to stay invested, rotate towards assets that pay reliably with liquidity and while liquidity shifts. So if liquidity drops, they're not going to get hammered like the tech space. So we like low correlated assets to public markets. This includes the private markets, private infrastructure with inflation-linked pricing and cash flows. We're looking at regulated utilities, toll roads, digital infrastructure, industrial complex. We favor private credit at this juncture because of, in many cases, not all, the lower correlation. We also are looking at fixed income in Brazil due to the attractive carry. In the equity space, we like keeping quality exposure in large caps. We're recommending tilting new capital towards companies that, as I mentioned before, are already producing the gains from AI, banks that use analytics to cut credit losses, utilities that reduce non-technical losses and improve collections, logistics and retailers, energy names. These are a few of the areas that we see outperforming in 2026. Again, we want to diversify. We want to incorporate some of the lower correlated asset classes into this diversified portfolio allocation, but size them prudently. Hedges. Hedges are very important, and these are risk controls. So what do we like here? We've been recommending gold. It's been a very good hedge. Treasuries don't seem to be a hedge anymore because there's a positive correlation between equities and treasuries. So you can look at tips, treasury inflation protected securities, and break evens for inflation risk. Use gold as a portfolio diversifier. In Brazil, use simple currency hedges to hedge yourself, and keep dry powder to take advantage of any downsides in the market. So the market sold down early in the year. Risk assets came off tremendously, and this is because major managers got spooked and de-risked. Then prices bounced and underweights were chased. That means that major money was chasing the rally. And every time you see this happen with dips, you're getting passive ETF investing, getting new inflows, and that pushes the rally higher. That fuels a rally out of proportion with changes in the real economy. So we also talked about liquidity. Money market funds remain near records with strong inflows. Now, when the Fed continues to cut, liquidity could be a vulnerability as money leaves money market funds from making 5% on cash to go elsewhere. Deficits and deglobalization will keep the term premium up. Real rates start high even as cuts begin. So we look at all of these macroeconomic variables and take them into consideration as we look into 2026 in terms of our asset allocation. So our basic recommendation: keep the core of the portfolio invested, make the core pay you while you wait. We see additional upside through year end due to still elevated liquidity and the purchase of dips. High valuations can continue for some time. Own private credit, own infrastructure, have some cash, buy inflation-linked securities, hold gold. And then also on the risk side of things, what we've been advising our institutional clients is to not just have a home bias, but look elsewhere. And Brazil has actually been one of those names that we like. In equities, we are selective and we favor AI users over capacity builders. And we think there are some opportunities in some industrials, especially in the defense sector. So the liquidity and narrative built this market. Cash flow and discipline will define the next stage of the cycle. So with that, I'm going to finish, and I thank you very much for your time, and I will be happy to take some questions, and all the best in 2026. Goodbye.